Fundamentals. I like fundamentals. I think fundamentals. I trust fundamentals. What are the economic fundamentals in our world today? 1, we're in a new global world. Anyone can sell to anyone else if they have the right price. Enjoy it. 2, information is now global. In most countries, except North Korea, the internet allows people to know what's going on. Fax machines and computers basically brought Russian communism to its knees. The internet is another word for freedom. 3, we're seeing the rise of Asia with its low, incredibly competitive wages. This means U.S. jobs, manufacturing, and services are moving to Asia. If you want to stay in business, you've got to think Asia. When you think Asia, you're also thinking bye to U.S. jobs. 4, the exodus of good jobs from the USA to Asia is slowly eliminating the middle class in the U.S. Want a job? Apply to Walmart or McDonald's or Starbucks. And oh yeah, the middle class votes. 5, a U.S. presidential election is coming up. The key to the election may well be jobs. Remember that word because Bush remembers it and Greenspan remembers it. Once again, repeat after me. Jobs, jobs, jobs. 6, in an effort to boom the economy and thereby create jobs, the Fed has created $1 trillion in credit over recent years and has driven short rates down to 1%. The Fed will continue on its path of inflation and low rates right up to the election in the hopes that its actions will somehow create jobs. 7, low, uncompetitive interest rates render the U.S. dollar unattractive to foreigners. Moreover, the U.S.'s twin deficits render the dollar even more unattractive to foreigners. If the U.S.'s foreign creditors, who hold tens of billions in U.S. securities, become discouraged or frightened, they will start selling U.S. securities, mainly Treasury bonds. For this reason, it will be crucial for us to watch the bond market. If there's any trouble ahead, it will show in the dollar, in bonds, and of course in the stock market. But it may show in bonds first. Oil. Here's a relatively new phenomenon, but believe me, it's an important phenomenon. This headline from a recent Financial Times, quote, China's thirst for crude oil is now second only to us. China has now overtaken Japan as the world's second largest consumer of oil. And another paragraph from the article, quote, anxious to diversify its suppliers and secure its own source of oil and gas, Beijing has directed its state-controlled companies to buy into oil fields in East and Central Asia and around the world. Chinese customs figures show that China imported a recent 91 million tons of crude oil last year, up 31% from 2002, close quote. Russell comment, the Chinese Industrial Revolution is driving up commodity prices across the board. The competition for oil will intensify. Rising gasoline prices amount to a tax on every automobile driver in the U.S. It's worth thinking about. Markets. Let's turn to the markets and the question, where are we going and how and when? I've stated that if the Dow closes below its January 13th closing low of 10,427, I'd sell half my diamonds, meaning the ETF, DIA. Otherwise, I'd sit. The chart below provides us with a bigger picture. The Dow spiked up to the 10,550 box, backed off 3 boxes, then rallied to break out to a new high at the 10,600 box. Ordinarily, this new high would take the Dow considerably higher. So far, it hasn't. For some reason, the Dow seems to be stalling here. Stalling is okay, but if the Dow now reverses and heads down, we have to watch for a sell signal on the point and figure. A sell signal would occur if the Dow breaks below the preceding row of zeros and hits the 10,350 box. So we have two down numbers to watch on the downside. The nearer one is the 10,427, and the more important one is the 10,350. That's the story. Everything else is guessing, conjecture, hopes and wishes. And why guess? Consider the trend is up or neutral unless proven otherwise. Direction. There is such a thing as direction in the stock market, and when you don't have values, you at least have direction, which is where my PTI comes in. My PTI deals in direction, and for this reason I've advised subscribers who don't mind buying overvalued stocks to trade strictly on the basis of my PTI. The simplest way to do this is to buy the Diamonds ETF, which are just proxies for the Dow. I've always said that to make big money in relation to your own assets, you have to take a big position. A big position in diamonds has paid off, but I don't know how many of my subscribers have been willing to bet big on the diamonds. Gold is an entirely different story. I've advised semi-permanent or long-term positions in gold. Why gold at all? Gold is real intrinsic money. I consider gold a great value in a world where paper money is being manufactured by almost every nation in alarming amounts. Eventually, gold, like all great values, will fully express itself against paper. It may take a few months, a year, 5 years, 10 years, but the primary trend of gold is bullish, and ultimately, the bull will have its way. At this point, amateurs are saying that gold is just a mirror of the dollar. When the dollar rallies, gold declines and vice versa. Forget it. I'm talking about the big picture and the coming discouragement with all paper currencies. That's why we hold gold, not because gold is rallying or declining today or tomorrow in opposition to the dollar. There are times in market history when you have to just sit there. There's nothing wrong with sitting. I've been investing since 1947, and I've been through these periods before. Sure, I've got a position in gold, and I own some bonds, and I own some German short notes, and a few utilities, and some DIAs, and a house, and 2 poodles. But I don't have a big position, more than 20%, in anything in particular, and that suits me just fine in today's atmosphere. For my kids, it's a rather different story. I don't buy them anything unless it has a relatively safe yield, and the higher the safe yield, the better. They can use the income, and there's decent income in some utility stocks, some closed-end foreign bond funds, some closed-end municipal bond funds, and some preferreds. In other words, for my kids, I strictly follow the compounding route. If it doesn't pay a dividend or have a good safe interest stream, I don't buy it for them. Now I want to turn to another subject. Being near 80 years of age has one little advantage. I know an awful lot of smart people in this business, and I read their views and output religiously. I follow Lowry's and the brilliant Joey Granville and the super bright Justin Mamis and the great Jim Dines and the Aidens and McMaster and GAN expert Jerry Favors and Sir Harry Schultz and Ian McAvity, Peter Eliades, and well, many, many others. They're a collection of the brightest people in this business, and each has his or her own opinion of what lies ahead. But in the end, the only time I'm willing to take a big position in anything is when I believe that the area represents a great value. I don't mind waiting. Sometimes it takes a year or 2 or even 5 before great values express themselves. The other side of that coin, buying anything that is overvalued, just give it time and it always ends in a loss. That's the problem with the public being in the market. The public buys on emotions, and emotions are always at or near an optimistic peak when an item is overvalued and receiving universal acclaim and publicity. So the public always ends up doing most of its buying in overvalued areas. The result? The public almost always ends up losing money. I really hate to say it, but this is the reason that I don't believe the average person should be in the stock market. If, over time, the public had done well in the markets, the majority of investors would be wealthy. I'll let you in on a secret. They're not. Looking back and then ahead, I started Dow Theory Letters in 1958 with $25 and an obsession. The obsession was about Dow theory and the stock market. The $25 went into, would you believe, a little gelatin printer. You type your piece, then you place the paper face down into this pan of special gelatin, and then you get about 15 copies off the gelatin. But 15 copies was all that I needed. Since I started with 15 subscribers who paid me $15 each for a year's subscription. Of course, at the time, I wasn't thinking of Dow Theory Letters as a business. I was doing it because I was enthralled with the markets, and I wanted to tell my subscribers what I was thinking. I don't have any idea what Dow Theory Letters is worth today. I've had attractive offers to sell the business. I wouldn't sell my business for $5 million or $10 million. The fact is that I wouldn't sell it at all. I like what I'm doing, and it keeps me interested. I like my life, and more money won't increase my happiness. I moved from Manhattan to San Diego in 1961, and I moved to La Jolla in 1967. I like La Jolla because it was beautiful and located right on the Pacific Ocean. There was a certain block in La Jolla that was my favorite. In 1974, I saw an ad in the San Diego Union for a house located on this particular block. The house was listed for $630,000. I knew the house because I knew every house on that block. Real estate in 1974 was not in great shape. I met the owner of the house and I told him, I know your price and I can't afford it, but I'll tell you what, I'll write you out a check right now for $570,000 for that house. The house had no mortgage. The owner said, well, let me talk to my wife. Excuse me for a few minutes. The owner went to another room and returned about 3 minutes later. He said, it's a deal. We shook hands and I wrote out the check. My real estate agent almost passed out. She said, I've never seen a deal concluded this fast. I can't believe it. I don't know what my house is worth today. It's situated a few hundred yards from the Pacific Ocean, and I know it's worth several $million or more. But I won't sell it. I love this house. I just want to continue living in it. I've seen better houses. I've seen much more expensive houses, but I like my house. Faye likes it too. And my 2 standard poodles love it. I also have about 20% of my assets in gold and gold shares. I don't give a damn where they go. I own the gold because, like my business and my house, there's no debt against it. The gold stocks mine gold, and I'll keep them because I believe gold is in a long-term or generational bull market, and I'll just sit it out rather than trying to out-trade it. I consider my business and my house part of my situation, don't you know? I don't owe anything on my business, and my house is free and clear. That's the way I want it. I know that bull markets eventually express themselves by exploding, and what happens if the gold bull market ends up that way? Would I sell gold for $500 or $800 or $1,000 or more? Sell it for what? More paper? Some other country's paper? Euros? Chinese? Renminbi? A new brand of central bank paper? I hardly think so. I'll just keep my gold position the same way that I'll keep Dow Theory Letters and my house in La Jolla.